Welcome to the class. This is for CMA part 1 and we will start formally our class today. Before I start, there are some new people in the class, so let me go through the course structure so they can understand how CMA works. So CMA has two parts. This is the part 1 class, and in part 1 we have several topics. These are in front of you. These are 6 topics actually. External financial reporting, that is 15% of the exam. Cost management is 15%. Planning, budgeting, forecasting is 20%. Performance management is 20%. Internal control is 15%. And technology and analytics are also 15%. So if you see that this subject is not one subject like accounting, costing, financial management, so there are various subjects in one part called CMA Part 1. So the beauty of the course is every lecture is independent. So you can choose your lecture, when you join, just you have to finish your 20 units and then you will be ready for the practice sessions, and then you will do a couple of mock exams and you will be ready to go for the final exams. Generally, it takes 4 to 5 months to finish your part 1, and then we can start part 2 after you finish your examinations. Exams are routinely available every time. So throughout the year, you can give your exams. Today, I'm going to start the responsibility accounting and performance management, which is a topic in performance management. So there's a very interesting topic and very practical and very, very useful. So responsibility accounting and performance measures, this is what we are discussing. Things to learn for the day is responsibility centers, performance measures in terms of cost center, revenue center, profit centers, then investment centers, comparing performance measure for investment centers, allocating common cost, transfer pricing, selection, and in the last, we will discuss about the balance scorecard. So these are all very, very high level topics. CFOs, director finance, corporate departments generally look around these topics. So it will be a good insight. Now let's start our discussion with the basic principle that how you are going to manage your organization, your company where you work. So there are always two ways. One is centralized and one is decentralized. What is centralized? Centralized means that you have a head office in America and you are working in UAE or Saudi Arabia, Oman or Qatar. So you are a branch office, they are the head office. Anytime you need to take a decision, you need to contact them to take any approval. So it means that the decision making is in the hand of the head office and you are following their instructions. That is called centralized way of management. The other is which Nestle is doing, all the multinational banks like HSBC, Standard Chartered are using. They are giving powers on different levels and they are taking them decision-making abilities. So this is called decentralized. For example, your head office is in America, you have a country manager in UAE. So this country manager is actually approving everything because his limit is already assigned. Then there will be a manager who has his own responsibility. So every management level has some kind of delegation and responsibility and authority to exercise. So over the year, we saw that in a big country and in a good organizations, with decentralized setup is always better. Centralized are good for those where there is you are working in a country where there's less education, less expertise, so you need to control everything from the head office. So both systems are fine, but it has its own advantages and disadvantages. So previously we used to say that I work in accounts department, I works in HR, I works in finance, I works in forecasting department. So now we use new words for that. It's called responsibility centers. Now the reason to make it them old department word as a responsibility center is that we want to show that you as a manager or a head of the department, you should have your own vision, you should have your own strategy, and these strategies should be aligned with overall organizational strategies. So that's why this SBU word is getting quite popular, strategic business units. If you work in a better size company, they use these words as a strategic business units. So I mean, you don't need to call any more department here. The next level is strategic business unit, which means that you have a strategy. Your department is a unit or a business unit which has its own mission, objective statements, and targets to achieve. So once we make into responsibility center or SBU, there are 4 ways we can classify our responsibility centers or departments, you can say. Now, the most easiest is revenue center. For example, sales department is responsible for bringing sales in the company, because every department cannot bring sales. Suppose we accounts, finance people, we don't do sales, we don't bring sales. We have a different job role and job description. So in that case, we have, so sales will be the first department to determine as a revenue center. And we will tell them, look, you should have a specific level of sales. You should meet your target, because all the organization is dependent on sales. You know, if there's no sale, you can't pay the salaries, you can't sustain even. Then we have expenses and cost centers also, we call them. Say we want to control the cost for maintenance, repair, production. So we make them cost centers or expense centers. In accounting, we know that if we take the revenue and we subtract the expenses, so it becomes profit. So profit center means that the best example is Carrefour, Spinning, Lulu. These all are retail store, Hyper Panda. So they have inner departments. When you go in a store, you see a lot of things, grocery, electronics, and a couple of other things. These all are actually departments. So they are profit centers. So the store is looking around their profitability. They are in profit, they are in loss. And that's why you see that in a retail store, there are a lot of changes happen. Sometimes they close one department, they bring a new department. When they close a department means that this department don't have good footfall. A lot of customers were not coming to the store. So they bring it with the new one. That's how the retail industry works. So profit centers concepts are really practical and useful. Investment center is the highest. You know, it includes all these 3 inside as an investment, because say the best example is branch office. Suppose you are Emirates and BD and you saw that Expo 2020 site is ready. Now you have to open a branch. So first you have to invest in infrastructure. You have to make a branch, this and that. Then this branch will have a branch manager, and then there will be expenses, revenues, you know. So investment center is the most huge complex, which will have investment. So in that we will calculate ROI, return on investment. Then we will see how much profit we have, because every month we should have profit, and the return on investment should also come. So the least simplest is revenue, then cost, then profit, and then investment centers. So any department you can classify in any way based on their nature of business. For example, you work in accounts department. I cannot make you a revenue center. I cannot make you a profit center. You cannot be an investment center. You can only be a cost center because you have a cost. You can't make sale. You don't, nothing invested on you as a return on investment. So, but sales department, we can make them revenue. Retail full department, we can make it as a profit center. And a branch we open, we can classify as an investment center. Yeah, so here it is into a different diagram way, the same thing that I told you. So we assign cost centers where the manager is responsible for the cost. So manager will take decisions in order to save you from unnecessary cost. I will give you an example. Suppose if you call an electrician and the easiest, and your set tube light is not working. So easiest for him is to say that we have to replace it, because he will just bring a new unit and replace it. That's the easiest. And if he don't have any incentive to save the cost of the company, he will certainly do this. But imagine like if it is a responsibility center, we have made him a cost center, and he will get some incentive of the saving if he will say. So first he will come, he will open the tube light, he will try to investigate that how he can fix. So maybe he can fix it in a way that it require a fuse, which maybe 1 dirham he will say faced. So he will make a cost sheet that this much money I save for the company, and that's how things will work for him. So it is an advantage to make a cost center that you want to control the cost. Revenue center. What is revenue center? Sales. I told you manager is responsible for the revenues. Profit center, where we combine the costs and revenues both. And investment center is profit and loss, and where you have a return on investment. So in diagram form, it's easy to remember. It's not in your book. We have put it as a Berkeley in your slides. It makes your life easy.